Good morning and welcome to the i3 Fixed Income webinar co-hosted with Blackstone, focusing on systematic solutions for lower carbon. I'm Tech Ted with i3, and I'm pleased to have Blackstone's Tim Kester join us today, all the way from the west coast of the US. A bit about Tim. Tim is co-head of Blackstone Credit's Systematic Strategies Unit. Prior to Blackstone's acquisition of DCI in 2020, Tim was CEO of DCI, which he joined at its inception in 2004. Now, let me just set the context for today's discussion. We know that investors are focused on sustainable investment and are gravitating towards strategies that can help them meet their ESG goals and net zero 2050. So for the purposes of today's session, we'll be covering fixed income, specifically systematic fixed income, and how that can again contribute to lower carbon exposures for the portfolio. So we'll address this topic in sort of two broad headers. Firstly, I think it's important that we get stuck into defining what is systematic fixed income. There could be some confusion or misunderstanding there. So let's get that right in the first instance, setting the context. And having done that, we'll seek to then apply systematic fixed income approach to achieving low carbon exposures. And I think that implementation bit is where it's really interesting to our audience here. So in terms of the format, this will be a discussion with Tim for a total of 40 minutes. Given the somewhat technical nature of the content, we'll use a number of slides at times just to help illustrate some of the points. Now, I encourage you, the audience, to submit questions via the question box, and we'll endeavor to answer them in the course of the conversation. This webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. So to kick off, Tim, welcome to the webinar.
Thank you. Good to see you.
Now, Tim, let's get cracking. Let's start with, as I said, setting the context on trying to define what is systematic credit. And if I could preface that, how different is what you mean by systematic credit comparing to, say, quant type strategies, you've got factor-based strategies like those employed by, say, AQR, Bridgewater, and Two Sigma. Help us to understand what you mean by systematic credit.
Yeah, oh, great. A lot of people, when we talk systematic, they immediately think quantitative, and we use a term called fundamental systematic just to distinguish it. So, if Sophie, if you show a picture, I'll show you what we mean by that. So we have been working on for 3 decades a fundamental cause and effect structural model of issuer default risk. And we've got a lot of faith in that. It gives a lot of transparency into the changes of risk, what's causing the firm's default risk to go up or down, therefore what we think the credit spread should be. And so unlike other sort of quantitative approaches, you typically are thinking it's more black box, it's more statistical, it's more regression based. You mentioned factors, it could be single style factors or stat arb, or we're not doing that. We have a very fundamental cause and effect model, so that's why we call it fundamental. But unlike sort of traditional fundamental discretionary, we apply the model systematically. And what we mean by that is we limit discretion to try to remove error and noise and bias in the investment process. And we rely on a lot of systems to kind of make it repeatable and scalable. So for example, we're not sort of constrained by the number of names we can follow. We can follow thousands of names in more or less real time. And we think it's sort of a consistent measure that we can apply across different regions, different geographies, high yield investment grade, long duration, short duration, bonds, credit default swaps, and with our partnership with Blackstone, extending it to loans. Now, you mentioned factors. We've been looking at corporate credit risk, studying the topic now for 3 decades, and we just don't see any evidence, of factors evident in corporate credit. A lot of the firms we're dealing with are the largest, most liquid firms. They tend to be value firms, and we do see sort of these one-time anomalies, but we don't see it sort of persist and shared across firms. What we're talking about in our approach is exploiting what we think is a good risk premium, but it's idiosyncratic. It's a mispricing.
Right. Tim, if I could stop you and clarify. So you're saying that factors don't really work. What you have here is, you call it, fundamental systematic, meaning a systematic approach to exploiting fundamental mispricing. And that's different from, call it, the black box style of factor investing.
Yeah, that's exactly right. I mean, let me just tell you what we're not doing, because a lot of corporate credit strategies are run, the apparently 99+%, and certainly in high yields run by this fundamental discretionary. Most of those strategies, we think managers are sort of going out of the index or taking extra credit beta or extra sector or timing spreads or timing interest rates. So the first thing I want you to know, Tech, is what we're not doing is we're not going out of the benchmark or the custom benchmark to the extent the client wants to customize it. We're not trying to time the macro spreads or interest rates. We're not trying to bet on a sector. What we're doing is using this fundamental model of default risk to exploit what we think is an attractive sort of mispricing. On average, we think the credit markets get it right, but there's quite a bit of dispersion. And when we look at that dispersion, it doesn't tend to follow into these traditional equity style factors. We think it's truly idiosyncratic, which is kind of interesting because it allows us to sort of add sort of an uncorrelated alpha stream as a result.
Let's get stuck into it. Now, again, some traditional investors, if you like, will point out that credit is an opaque market, and you talk about data is woeful, and you mentioned about equity factors. So comparing to equity trades, where often it's published, it's instantaneous, it's for everyone to see, there's an official closing price, and so on and so forth. But corporate bonds, for the most part, have no closing price. Even when trades are publicized, well, it's delayed, it's fast, and some would say there's no what you call an unambiguous source of truth. So there are problems there. Obviously, your process is data-driven as well. How do you overcome these problems?
No, they're massive. We've been working on parts of this problem for 3 decades. So we totally agree with you. We tend to focus, Tech, on the certainly there's a lot of bonds that don't trade. So we're focused on the most liquid names. We exclude the less liquid names, but we've just spent an enormous amount of energy cleaning, scrubbing, linking the data, excluding parts of the universe that we don't think you can buy the prices of where they say they are trading. So that what we're trying to do is get real implementable portfolios that track as closely to our model, so we can deliver our back tests to investors. But that's taken quite a bit of time to do, and so we spend an enormous amount of energy on those types of things. And I think what you'll find is that people coming out of the equity world trying to apply those, it's not so simple as sort of 2 people in a Bloomberg, given exactly what you just said.
Sure.
And there's been advances, like Trace was a huge advance in trying to bring some transparency to pricing, and there's a new, more sort of recent development on the observable intraday dynamic bond pricing. So we're leveraging all that, but you're exactly right. This is a much more challenging area.
And challenging as it is, you talk about benchmarks. Let's talk about alpha generation, because at the end of the day, it's what investing is all about. So there's a comment here that say, look, the vast majority of active managers fail to beat their corporate bond benchmarks. Probably the best example is in, say, in the high yield area, where even some of these passive ETFs trail the index by some margin, and over any reasonable period, active managers do struggle. Is this an issue? How do you see this problem?
No, listen, I mean, this is one of the reasons we think there's a lot of openness now for investors on corporate credit to look at something other than traditional active. I mean, we hear the complaints that similar to equities, the bulk of active managers are index minus, charging fees, and no one really wants to pay for beta. And what we find with the ETFs is they don't necessarily deliver the beta, and they're not actually cheap. So in terms of is your question more, should we talk about the process of how we do it? Or
yeah, maybe like what's so different? You talk about your fundamental systematic process, and again back to the point that active managers don't seem to do too well passive ETFs against high yield. What's so different with what you're doing with your process?
Yeah, let's maybe Sophie, we can go to the slide on the process slide. I think it's slide 4. What we're going to do, Tech, here is we're going to take any sort of index that we can get good data on. So for example, if you well, here you're showing slide 3. This is just one to go back to your previous question, Tech. Sophie, if you even go back a slide earlier, just to give you a sense of how long we've been working on this problem, which is an embarrassingly long time. Some of these ideas came out of the Wells Fargo Management Science Group. My colleague who created that group, Mac McClown, who also created the first equity index fund, came out of that with a guy named Ulrich Vazicek, teamed up with Stephen Kellefer, who's our head of research for systematic at Blackstone Credit. And we formed a company called KMV, and we were really in the business, and I was part of that firm, trying to take all this data and put together measures about 40,000 firm default probabilities on 40,000 firms, the first sort of portfolio management tool for corporate credit. And Australia, Tech, was a good market for us. And then we created this DCI after we sold that business to Moody's. We put that into action, and that required a lot of data, a lot of linking, a lot of filtering and scrubbing that I mentioned, and we're running now strategies for the last 17 years until obviously last year with teaming up with Blackstone. But if we go to the next slide, so if you'll just see a little bit of look behind the scenes, there's just an enormous amount of infrastructure we built over the last couple decades to do this. And as Tech mentioned, it's not simple. But to answer your question on what's our process, so if we can go to slide 4, we take in a benchmark. Now, we're not benchmark constrained. If we want to do blended benchmarks or custom benchmarks or ESG excluded benchmarks, that's fine. Here we're just showing you the high yield index. And this is a typical picture we show. On the vertical is the option adjusted spread on the corporate bonds in the index. So the higher the point on that graph, the higher the spread. And on the horizontal is using our proprietary measure of default risk, converting it to what we think it should be trading at, given the default risk that we're measuring, which we think is a more accurate and timely measure than the credit market. And what you notice right away, Tech, is despite on average, there's a lot of names lined up around the gray dots. I don't know if people tuning in on their phones can see that, but there's about half the names that look cheap at any one point in time, despite whichever index you look cross-sectionally, about half the names shown in blue. So one, we'll define an index. We'll stick within that index if the client is worried about tracking error. We'll stick with only public firms because a lot of our information edge is coming out of the traded equity markets, interestingly, despite what you read, where they think it's backwards. The bond market leads the credit market, the bond market leads the equity market. We find it the reverse. Second step, and this is a 5-step process that we feel is pretty easy to explain to investment committee, is the second step on slide 5 is we're going to filter on liquidity to go up against that question you just mentioned. We want to make sure these are achievable portfolios, that the portfolios we're delivering into the investors are matched to our model and matched closely to the benchmark. So we're going to roughly throw out about half the names, interestingly. So half the names in the high yield index, half the names in the investment grade corporate bond index are not liquid enough. They haven't traded within trades over a certain time period and so forth. Step 3 is we're going to focus on the cheaper names. So the names that have too high a spread that we don't think is a liquidity, because we just filtered on liquidity, we think it's a true mispricing on the individual bond basis. And we're going to form a well-diversified portfolio of about 150, 170. And then step 4 is we're going to kind of upweight the ones that have the most mispricing and are fundamentally improving, subject to, in this particular instance, a 2% cap on our high yield strategy. And then this is the most important. We're going to, on the next slide, we're going to just take that portfolio of 170 liquid, positively mispriced names that are fundamentally improving, and we're going to match it. We're going to match the credit beta, the sensitivity to credit spreads. So if spreads go up or down, we should be matched to the benchmark. We're going to fully hedge the interest rate risk to whatever they want. Tech, a lot of talk about rising rates here. You don't
Yes.
have to take the full duration index duration. It's extended a little bit from 3 to 4 years here in high yield and more in investment grade. We have more and more clients going to zero duration. We hedge it separately anyway. So you can try to get the credit beta plus hopefully alpha,
Sure.
and then hedge it to zero. If you really have a view on rates, we can go sort of minus 2 year duration. So there's nothing saying that we can hedge it to whatever. And then the last part is the value added from our perspective, that we're going to try to get you that safer beta, but beta 1 to the index with this excess return, because that convergence process usually takes about 3 to 6 months tech, although higher vol, faster speed of it converging to fair value, it's uncorrelated because it's individually specific to the firm.
Yeah, Tim, there's a question here, and I think you alluded to it a bit. I guess when we look at the macro environment, impending rate rise, what does it mean again to this approach that you have?
Well, we think that the rates get embedded into the forecast of the equity markets. We use equity market information to leverage both the asset value of the firm and a default probability calculation and the volatility. So to the extent you're in a rate sensitive environment, firm,
Sure.
that should be reflected, but also it helps with overall yields. I mean, as the default free goes up, yields go up. It hopefully makes fixed income more attractive. And of course, we run a long short strategy where the cash sits in short-term treasuries and we go long short trying to get dual sources of this convergence. Of course, as that default free on the 3-month treasuries gets back into some interesting range, that gets ported onto this already, what we think is an attractive alpha that we can do it. So that's sort of the impacts.
And I guess rate rise aside, your strategy is well and good. Just curious, are there particular market environments perhaps that you would see this approach struggle?
Yeah, I mean, yeah, there's most of the time we're in an environment where fundamentals matter, and so our strategy is to take advantage of this mispricing, but still deliver the beta to the index. And what I mean by beta is the credit beta, and the way you can do that is because of this mispricing. So vols are high now, and it should be a good environment. There are 2 environments, Tech, where our strategy usually gives up some ground to the index. One, you have an indiscriminate blow up, like the subprime crisis. By definition, that's not fundamental. That's indiscriminate. So we don't typically lose a lot of money, but there's no guarantee we're going to make money because it's indiscriminate. So we don't do anything other than wait for the settling out period to happen. Usually when fundamentals come back, especially if it falls higher, on the backside of that, we tend to do a little bit better. And the second thing is junk rallies. So if we're avoiding the riskiest names, getting our beta through the lower risk names and the alpha coming to us, sometimes, like you saw in 2018, the second half of 2020, the riskiest, junkiest names outperformed their credit beta. So periods like this, we're going to give up some ground to the index, but it doesn't look like we're in a junk rally at the moment.
Right. And I've got a point here around tracking error. I think we'll probably talk tracking error later on in carbon, but I guess with your approach, I sense that's not really an issue where you are very conscious of obviously the benchmark in terms of your approach.
If you go to I think it's the next slide. Let's see, Sophie, the return slide. So notice a couple things. We're trying to offer 3 things here to investors. Beta 1, what do we mean by that? Rates hedged, credit beta matched, and what you're seeing here is the live return in green. Now notice that orange line or the gold line, that's the B of A Merrill Lynch Master 2 Issuer Constrained High Yield Index that this particular fund or strategy is going up against. Notice the ETFs there, Tech don't even deliver the beta 1 of the bond indexes. A lot of those names don't trade. So we're going to give you that, and we're going to try to offer a little bit of alpha, but because the credit beta and the rate beta and even sectors are tightly controlled, notice the tracking error. So we have about a 5.5+ year history now. We launched this mid 2016. Tracking error about 1%, same or lower as the ETFs. Good information ratio coming from the idiosyncratic mispricing, subject to the caveat that in indiscriminate blowouts in junk rally periods, we're gonna trail the benchmark. But over time, this has been a pretty good steady series of little bets, uncorrelated bets, but the overall macro picture, rates, credit, sectors tightly controlled, gives you the low tracking.
Right. So I think with I think we've sort of established the context for the approach. And what I'd like to go is move into the second part, which I think is the more fun part, the application.
Yeah.
Sorry, Tim, I know you're a fixed income guy, but I think application is probably more fun, more practical in a sense. So
Yeah.
draw this approach, into, I guess, low carbon, where obviously we know all investors are very cognizant of. So how do you apply this approach into, say, adding low carbon targets to the process? And if I could, again, preface it, top of mind, some are calling it low hanging fruits. First off, why do you just exclude an energy sector? And I think the Australian investors in the room would identify that we've got huge exposures in the local exchange. Is that the way to go?
Well, that's not what we do. That's what a lot of clients say, just exclude energy. And there's a few reasons why we don't think you want to do that. First of all, unlike equity markets, where I'm not depending on your benchmark, it's a couple percent. In credit, and certainly in the high yield, U.S. high yield, global high yield markets, energy is about 15+% of the total weight, or we think of it in terms of total duration time spread, total risk. So it's a huge amount you're going to be excluding. It turns out to be one of the highest performing sectors the last year and a bit, or 2 years. And if you were to just X out energy, we're showing it on the top right picture there, you would have, significantly lower returns, and obviously in a low rate and still environment that our investors want every basis point sort of counts. Now, here's the main reason you don't want to do it. When you run our process on X energy, it doesn't lower the carbon, which is kind of interesting. I mean, and that's what we're showing in the bottom right. It might be hard to see, but now let's define carbon, because there's a lot of, we're not experts in carbon. We sort of go to our clients, and the task force on climate-related financial disclosures has recommended this weighted average carbon intensity as a portfolio metric of how exposed you are to carbon in your portfolio, and you can compare that with the index, for example, or other strategies. So we're taking carbon intensity, which is the amount of CO2 equivalent in metric tons divided by a million per revenue of the firm. We're getting that from a third party, verified and independent. We're using true cost from S&P, but you can use it from MSCI and other vendors. They have similar sort of, unlike ESG ratings, it tends to be less subjective. It tends to be less arbitrary. They seem to be ranked the same by these different vendors. So we take in that carbon intensity data, and when you weight that based on your portfolio weights, notice if you just X'd out the carbon, the energy index, you would have that blue line, which sometimes is above the weighted average carbon intensity, defined as scope 1, scope 2. So that's another recommendation from the task force. We can get into what that means, but notice it doesn't really necessarily, and the reason for that is there's other industries, utilities and other industries that have transportation, that have a lot of firms that have orders of magnitude more carbon intensity. So you're not automatically lowering carbon by excluding energy. With that said, because systematic affords this customization, we'll do it.
Can I just clarify? Obviously, you say you don't exclude energy. So what you're saying is that you are potentially, and I might be oversimplifying this, you're picking the least polluting energy companies. So you're not giving away alpha, but at the same time sticking to that universe of stocks or credits that you're looking at.
Yeah, you're exactly right. People then think we're just excluding them, or it's a screen, and it's not even that, because these carbon intensities are dynamic. They'll change. We get them every day, although they're reported sort of on an annual basis. But we get them into our system every day. And what we've noticed, Tech, is just like rating or sector or geography, our mispricings tend to be pretty balanced and dispersed even across the carbon metric dynamics. So in other words, we're able to sort of, if we show the next slide, I think we've got a picture on this. This is again the high yield, US high yield index. The size of the dot is the weight in the index. I didn't probably explain that last time, but it's a debt issuance weighted index. The more debt you issue, the bigger the weight. So the size of the dot. This is just showing the mispricing. We kind of prefer the names that are in green that have high spread relative to their underlying default risk, and try to avoid the names in gold and blue. Now look at what we've done here is we've just overlaid the highest carbon quintile of emitters in the high yield index. And notice it's not kind of biased. It's not like all our alpha opportunities, which would be the two green shades of green in the dots. They're not all coming from the highest carbon. So when we bring carbon into the process, and here I mean not screening, we're going to bring it into a portfolio optimizer, and the optimizer is going to say, optimize on the alpha, so the higher mispricing, the better, subject to some constraints, beta 1 to the credit, sectors not above 200 basis points of DTS to any one sector, and carbon on a weighted average basis, 50% or better than the benchmark. And so if I show you the next slide, we'll just tie it all together in terms of a series of 5 steps again. So the client gives us a universe. Again, more and more clients are now giving us more customized, bespoke universes. And if we have the data, we're happy to do that. Then we apply our filters. Even if the client says, well, wait a minute, what are the costs of those filters? We need to be able to get out of the name once it converges to that fair value 45-degree line. So the strategy needs the liquidity, even if the client doesn't need the liquidity. So we filter on liquidity. And then we're going to use our mispricing model, which we didn't cover, Tech, but I'm happy to go back through that example if an example of a fundamental mispricing company example is if you feel is important. We can identify using our model with, again, no discretion. We can't say, I don't like this name, the trader takes it out, and identify the cheap names in green there in 3A. And then what we do is we directly integrate, not filter, not screen, directly integrate the carbon intensity, upweight the alphas in the portfolio optimization subject to no single name in step 4 greater than 2%, and the portfolio can't have more than 50% of the weighted average carbon intensity, scope 1, scope 2 to the benchmark. And then the final step is to ensure that always is the case. Rates are fully hedged to whatever the client wants, including zero duration.
Sure.
Usually they pick the benchmark and we'll fully cash flow match it and then hedge the credit beta to the benchmark as well. And so where's the alpha? The alpha is coming from that individual credit convergence.
So I guess, can you sort of, if you like, hand on your heart, I mean, we talked about doing well and doing good. Now the $60 million question is alpha eroded? I mean, is there degradation of alpha across this process?
Tag, it was very clear to us it was funny, when I went out with this strategy, I was thinking, you know, they're going to jump all over it, and they're actually, we actually thought they were going to seed another fund or another vehicle. Very clear to us, alpha is the #1 goal. You know, they want to do good, but they also have a fiduciary duty, you know, deliver returns to their stakeholders. So #1 is alpha. So we thought we carefully looked at this. I mean, we were not just trying to, you know, do this because everyone's talking about it. We really wanted a solution. If there was a huge degradation in alpha, we would not have done it. So if you look at the next slide, because of, well, actually, Sophie, if you go back a slide, can you go back a slide, Sophie? If you go back a slide, notice this is what we're seeing over time. This dispersion goes up and down, but we're not seeing a systematic bias that all the cheap names happen to have higher carbon intensity. So if you were to take out those from an optimization perspective, downweighting those, you'd give up alpha. So our expectation, Tech, is there would be no alpha degradation. We just converted 3 of the funds, because when I went out on the summer last year on this tour, hoping they're going to seed a new fund, they all said, Tim, if there's no cost, just convert the fund so I don't have to redeem, have the tax consequences and go into a new fund. So if we go to the next slide, this is real data from our convergence, which we just completed in the month of January, Tech. We took our time, we converted our high yield UCITS fund. We've been dealing with daily UCITS funds since 2004 when we created DCI, now Blackstone Credit, systematic. And we had global IG, investment grade corporate UCITS, and short duration UCITS. And here's the high yield. This is just focusing on energy. Interestingly, we took the month of January to get the portfolio to 50% lower carbon, which we're at. Interestingly, the weight to energy went up slightly. The alphas went up, meaning we took our opportunity to get out of energy names that had converged to fair value and get into new cheap energy names And we brought down the contribution to the weighted average carbon quite a bit just in the energy exposure. So there's about 30 names that we had coming into this conversion. We still have about 30 names. We just highlight this one example. So where you see that we removed the one shown in gold and added a new name, and notice the weight to energy didn't really change, but dramatically lower carbon intensity changed on that particular exposure and the contribution to the portfolio. Now, you asked about the returns. If we go to the next slide, so the dotted line is our back test. Interesting to note, the back test for low carbon exceeds the back test of our regular strategy. Why is the live slightly above low carbon? That's because the live has outperformed our back test. The reason for that is we tend to lag the back test. Obviously, things can change, but we think that there's probably no, and look at the tracking error, same tracking error, same uncorrelated alpha, similar results. So why not, if it doesn't cost you anything, why not just convert what you had? And so that's the path we took.
Tim, I just heard you saying that this strategy is live, it's not just another back test.
No, so it's live. So we went, what I'm showing you here is the back test since we went live with, so the live data is green. The back test is as if we went to low carbon when we launched it mid-2016 is the dotted green, but we just converted our 3 UCITS funds to low carbon. We offer managed accounts with or without low carbon depending on the client preference, but it is live for the 3 UCITS funds.
Right. I've got a question here again to our audience. We've got about 5 to 7 minutes left, so feel free to ask questions. Tim, you've talked about the energy sector, and I'm wondering if, again, just hearing from you, I don't think you are sector specific, you're more agnostic, but you've covered energy. There are other sectors, you mentioned transportation, which again, it could be a major polluter. Do you look at sectors like these, or you're agnostic really? You're looking more fundamental?
Yeah, our goal, Tech, is the breadth is important. So we don't like to exclude material sectors. I mean, we have some SRI exclusions that our clients feel strongly about in our UCITS funds, like for example, no coal and no gambling, or but in terms of material sectors like utilities, and we want them all because we 2 reasons. One, we find there's just as many positively mispriced names that have a much lower carbon than higher carbon. So we can deal with carbon as we just showed you. In terms of industries, our clients are very clear. And this goes back to what is systematic. We think systematic is just as much a client communication governance tool as it is an investment process. So our clients say to us, don't take any macro bets. Don't wait for dry powder and then invest. Give me beta 1, credit beta 1, give me rates, whatever they want, but you do the individual credit selection. Don't take big bets on sector. Those big bets have a low Sharpe ratio. If you get them right, you can make a lot of money, but it's not our edge to. So what we do, Tech, is we don't run it neutral to sector, but we run it with very tight tolerances. So we're agnostic where the mispricing is, but we tend to find that the mispricing is pretty balanced across sectors as well. So we're going to be in all the sectors.
Sure, yeah, I guess put it this way, don't swing for the fences.
It's hard. I mean, it's tough. Look, look at rates. Rates were going to go up. Rates went down on Friday. The 30-year rates, right? I've been hearing about rising rates for a long time, so we're agnostic.
Yeah, Tim, this is question here, which again in the Australian context with regulation, I'm sure you're familiar. We talk about benchmarks, we talk about alpha, and so on and so forth. Bring it all together. In Australia, we have this legislation called Your Future, Your Super, where unfortunately there is those benchmarks that investors have to stick to. With this approach, how customizable it is to have, I don't know, a low carbon version that adheres to the Your Future, Your Super fixed income benchmark, which is really the Bloomberg Barclays global ag here.
Yeah, we have that data in house, and we're actually in the process of showing that to a few Australian pension funds right now. Just where our edge is going to be, and the alpha is going to come out of the corporate piece, and to the extent that the global ag has X% in corporate, what we're going to do is hedge the other elements of the ag, the government pieces. And we have various flavors of that, Tech, but we tend to recommend bringing the ag back into balance, because not too long ago, a few decades ago, corporate was about more like 50% of the ag versus sort of 20. So we can show the client hedge total rates to the Bloomberg Barclays Ag,
Right.
hedge the other segments or sectors, as they call them, to the Ag. But on the corporate piece, we can run it with the current weight, or kind of recommend bringing it more back into balance, more of a 50-50 like it used to be. Again, lots of customization is available, low carbon available on the corporate piece. Here.
Sure. And Tim, final question, if I could sort of look back to the opening remarks where you were comparing, systematic, fundamental, and then there's the quantitative, systematic, and so on. I recall in previous conversations when, I guess, factor investing and so on were a bit of a rage there. Let's talk about, crowding out and being too much money in quantitative strategies. I'm just wondering whether this applies. Look, if this approach is as good as what you've mentioned, more money follows this approach, could there be crowding out in sense in this sort of strategies?
Yeah, we've been waiting for that, Tech. We've been we welcome those dollars, and a few of my colleagues are probably on the line that will take your call. We had the Super Bowl yesterday. I don't know if you guys watched that in Australia, but it's a big event here, and like 6 of the 7 ads were electronic vehicle ads, which is interesting. But only 9% of the cars on the road today are roughly are electric, fully electric. Interesting. So lots of talk about systematic, the rise of systematic fixed income. We're waiting. Apparently 99% of all high yield is still discretionary. So
right.
I think there's a long way. We're in very early innings here. And why we've been waiting a sec and working on our models and adding low carbon and doing all that and different strategies. The corporate credit markets have roughly doubled the last 10 years. So we've got 15 trillion now in the global corporate index, which is a sub-index of the global ag you just mentioned. And high yields roughly doubled to about 2 trillion. We're actually even doing EM corporate now, and depending on how you measure that, there's several other billions. So there's a lot of scale here. And I think that was one of the reasons Blackstone bought DCI, because they really see a scalable, liquid credit market that really has been a lot of opportunity for systematic. So in theory, you're exactly right. More people, more money chasing it. But remember how we can't even define systematic. There's so many flavors. A lot of people believe in factors are going to work in corporate. We've been studying it for 30 years. Don't see that evidence. We think it's actually beta, some form of beta, or temporary mispricing that's not repeatable. So I think there's some time there. We got a lot of runway hopefully here, Tech. But I look forward to that day when we have to worry about capacity and output decay.
A good problem to have in the future, maybe. Look, on that note, Tim, thank you very much for sharing your research and to the team at Blackstone as well. I guess the subject of ESG integration is very broad and obviously important. To our audience, what we've done here is really just to drill down on a very specific sleeve and more importantly, I guess, focus on the implementation bit relating to regulation, relating to benchmarks and the like. So I hope this has been educational, relevant, and practical. Looking around with the health situation improving, I hope to see everyone in person at some stage. So stay well and bye for now. Thank you very much, Tim.
Thank you.